Chris Toomey. He's been very, very bearish. He runs private wealth. And let's hear what he has to say.
Here at Post 9. Well, you're consistent. I'll give you that. But why are you still negative? I'm trying to think, you know what? When I knew you were coming up, I'm like, how am I going to handle this interview? I feel like I ask you the same questions every time.
Yeah.
Because I have no choice.
Right.
But, I mean, at some point, as this market, as we just said, is off to its best start in 5 years, you would think that your position would change.
Right.
Why hasn't it?
I think it hasn't because while we have seen tremendous economic growth that we weren't expecting, we've seen inflation come down, we've seen a very strong labor market, the things that we're concerned about continue to be things that we're concerned about. And I think why we're particularly concerned right now and why we think this rally is so remarkable is I think if you look at the pace over this period from October to now, you know, we actually have not even seen a 2% correction. And over that time period, we haven't seen something like that in over 6 years. If you look at all of these sectors that are doing well, on a technical basis, they're all either overbought or extremely overbought. So in our mind, I think even on the short term, we would all agree that the market could probably take a breather. So I think from a technical standpoint, from where we have been, I think it wouldn't surprise us to see a pause or, more importantly, probably see a pullback given how far we've moved and how aggressive we've moved.
Okay, that's all fair. And I think you're right in suggesting that nobody would be surprised if there was a pullback, some kind of a correction. I mean, that's what happens in bull markets. However, you were negative. You've been negative since before the market got into the conditions you suggest now make it ripe for a pullback.
So, and let's talk about the underlying thesis behind that, right? So the underlying thesis was the Fed was not going to be as aggressive in cutting rates as the market was pricing. And we saw 2023, instead of rate cuts, we saw rate hike.
All right, so let's read through his note bullet points here that he's sending to the private wealth clients here, okay? Saying market is extended on a risk return basis. I can't disagree with that. Negative 10% pullback would make P more reasonable. Definitely, just factually, that's true, yes. Economic trends aren't a recipe for success. I think you can make arguments both ways. I really think you could make arguments both ways.
We started the year, you talked about this before, instead of getting...
But very important, I do agree with this. This point right here specifically, right? And that's just literally factual. Market is extended on a risk return basis. Yeah, if I look at the market in general, I would definitely say the market in general is not super attractive right now. If I'm just thinking S&P 500 returns over this next bit of time, it's not. But, you know, 10 years from now, it will look like a deal. But, you know, a year from now, it might not. So I can't say I disagree with that.
Rate cuts.
But with that being said, there's a lot of steal deals in the market. There will be a lot of stocks that will perform great over this next year or two, even if the market doesn't perform great.
Potentially getting two, right? And then let's talk about earnings. Earnings last year were flat. Earnings this year, even with the dovish tone and economic growth that we're talking about, are not really going all that much higher. So if you look at the performance, 90% of this performance is PE multiple expansion. And so at that point, are you looking at a situation where the equity market, from an equity risk premium standpoint, is really not giving you that bang for the buck? In our mind, yes, maybe you're right. This is a bull market, but, you know, as Roy Newman said,
it's a bull market, my friend. I mean, the market is telling the story, not me. Right.
Of course. But what is driving that market, right? So even if you go deeper into earnings last year, right, you take out the market cap weighted, you look at equally weighted, those earnings are negative. If you strip out the Mag 7, earnings are actually down 10%. And you're talking about breadth in the market for this quarter, which you're starting to see particularly in February. But if you look at the performance, the 10% performance, 30% of that is one name. Right? So you are starting to get some breadth, particularly with some of the larger names in different parts of the sectors. But the median returns are still around 2 to 3% in each of those sectors.
Okay, let me take a couple points off of what you said, and we'll debate this. Earnings. So we went from an earnings recession, right? We were negative earnings for multiple quarters. And then, as you said, we got flat. But now we're going to grow again. Right. So the trajectory from earnings looks like this, right? We went from negative to flat to now we're expected, as I said, for the first quarter, some 5%. Now, maybe down from what was 10%, but it's nonetheless 5% versus negative. Right. So that's one thing. And then do you really want to be negative on the market into a global cutting cycle? Well, which is what we're going to have. We're going to have that
at some point, right? But let's talk about what are the things that might affect that, right? So growth has done well, right? We saw January, February CPI and PPI numbers that ran hotter, and you can talk about owner equivalent rent and so forth. But I think some of the other things that are a concern are the fact that if you look at gasoline prices, right, which was a tailwind last year, it's up 16% this year. Food prices are up 9%. Consumer sentiment's going down. Concerns with regards to the quit rate is going down, right?
Wasn't consumer sentiment good today?
Yes. But, look, there's a variety of different consumer sentiment numbers.
But come on, the consumer's been good.
The consumer's good.
The consumer's been strong, and optimism still remains.
It does, but what's going on underneath the scenes, right? You're in a situation where the consumer has got over $1 trillion worth of debt that's paying 20%. Right now, non-mortgage debt is actually equivalent to mortgage debt. So you're basically paying exactly what you were paying before, and savings have come down. So the issue is, for me, is not just the fact that the rates have to come down. If rates stay higher for longer, that's going to be a really problem for a variety of different areas of the economy, and it's not being priced in right now.
Oh, boom, 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 boom. 100%, okay? Before we get into Tesla here, let's just speak about the state of the consumer, right? The average person. So, real wages have started to tick up over the past year. That's good, right? With that being said, we're not really seeing great results with a lot of the consumer-related companies. You look at Nike's results, obviously look at Lululemon. That's one of the worst performing stocks here in the first quarter of the year, right? They showed it, I think, either in this video or one of the previous videos. I think it was down like close to 25%. Apple, obviously the biggest consumer company pretty much seen out there, right? Their numbers have been not impressive at all. So when you look at a lot of these consumer-related companies, look at RH, and obviously they cater to the rich and the wealthy, right? RH's numbers were awful. It was a D- income statement. I graded that income statement inside the private group last night. It was a D-. It was horrible. So their stock was up huge today because of who knows what. But, it certainly wasn't anything on the conference call. It's just the hope of things getting better in the back half of the year and the guidance, which we'll see if that happens. But, I thought he brought up a lot of fair points there. Okay, overall in regards to the overall market, right? Key Fed inflation gauge rose 2.8% annually.
The big moment we've all been waiting for, our February read on personal income and spending and all those inflation numbers. On the headline, as Steve pointed out, expecting up 0.4%, comes in at up 0.3%. Now, the revisions aren't showing yet, but maybe as we go through the rest of the numbers, they will. Personal spending up 0.8. That is a stellar number. 0.8 is the best number going all the way back to January of 23. If we look at real spending, up 0.4%, that is the best level going back to December of last year. And if we look at the deflator month over month, up 0.3 as expected. And here we go. Year over year deflator, 2.5, 1/10 higher than 2.4, which was the lowest level since February 21. This is 1/10 higher than that, but as expected, it really does break a streak of numbers moving lower. Now, let's look at the PCE core deflator month over month, and that is up 0.3. It's definitely less than 0.4 in the rearview mirror, as expected, and my favorite is 2.8 on the PCE core deflator year over year. 2.8 as expected, which means it remains at the best levels since March of 21. Okay, revisions are coming in now. I'll hit the ones that are most important. On the year-over-year core, I just went over. Last month's 2.8 now becomes 2.9. So we're actually lower But if I was the market right now, Steve Leisman, my guess is that these numbers are generally as expected, but we're not making progress on year over year. So the market.
And this is an issue, right? This is a big issue. And that's what cracked me up. Of course, it got revised upward, right? And this is a trend we're seeing. This is why people don't trust a lot of this government data, because it comes out and then it, like, more than not, it seems like everything gets revised worse than expected a month later. And they're like, we're revising this. And it's like that with unemployment many times and in jobs and in all these sorts of metrics. And so this is why people have huge trust issues with government numbers. And it makes sense.
You're going to have to fight that out.
Steve, want to get your reaction to this as I hear you say, wow.
Add to that.
Rick, you are the market, Rick. I don't know if you were the market. You are the market, man.
Today, he's the only market.
Look, it's chill on the inflation numbers. It's hot on the consumption and the spending side. As far from what I can tell, income was 0.3, but outlays was 0.8. I mean, that's blowing me away. What did you say, Rick, about real spending was up 0.4%? That's inflation adjusted?
Yes,
is that 0.4%.
Yes, 0.4%.
Diane,
exactly right.
All right, Diane, right here on TV, putting the pressure on you. This is going to upgrade our first quarter GDP numbers, isn't it? What do you got? Can
Absolutely.
You do it on TV?
And in fact, I'm looking at the.
Do it in your head.
I'm doing in my head close to 2.5%. I'm thinking on the first quarter. So how's that for you? But I do think what's also important to remember, Waller pointed this out as well, and it's where everyone had declared victory. And Rick, you're right on the year over years, but the 3-month moving average, the 6-month moving average on all of these figures has moved up with these numbers, as far as I can tell, with the revisions as well. They've moved up. That is the wrong direction on momentum for the Federal Reserve on CPI, and with that strong consumption number out there as well. That's going to be, we already have people staking out the sort of pushback for a June cut. What's the rush? Wait a little longer. 9 of the 19 participants wanted 2 or less cuts, and it's only 1/4 point move by one person within that meeting that brings it down to 2 cuts for the year. I know that's splitting hairs, Steve, but the timing of rate cuts keeps getting moved out. We need to see a lot of improvement in terms of inflation in March before we get to a June cut, but also a big slowdown in employment.
I'm shaking my head, Diane. Diane, I'm shaking my head because I don't think this market needs to see anything from the Fed. The way they've been trading, it's been quite remarkable, right? I mean,
the market may not. I'm talking about the Fed.
The Fed, I'm saying right. A very significant, I'll let Rick and Northern talk about this, but I just point out you've had a really significant reset on Fed expectations, down 300 basis points for the year-end funds rate over the course, and stocks have gone up and hit new highs in that context. And I think that's the context for everything we're talking about here today.
So what does that mean for the stock market this upcoming week? I think it means a whole lot of nothing, just to be honest. The fact that a lot of those numbers just came in kind of what was expected. I don't think that's necessarily great bullish news, like everybody's going to flip out. I don't think that's, super bearish or something like that. I think it's what was expected. So I'm not expecting a huge move either way. The revision upward to 2.9 for last month, I think is more cause for concern, because then you look at this number and you're like, well, is this number real? Or is this going to be something that next month we find out's higher than, expected, right? And the Fed looks at all those revisions as well, and then they make judgments based upon that. So, I don't know, maybe cut in July, but we'll see. We'll see. Alrighty, next one up here, buy stocks on weakness that typically benefit from rate cuts.
Hey here, Mel. It's great to see you guys.
So here's the first question, though. Rate cuts happen in a backdrop of the economy weakening, or is it because, what happens
So it is weakening in the employment data. And I think one of the most aggressive topics that I talk to clients about is how bad the incoming data is. So I'm going to take you a little bit in the weeds here. There's something called the initiation survey rate. It's when I reach out to you and say, how many people do you fire? How many people do you hire? I'm the BLS, you're the company. Before the pandemic, 70% of the companies would get back to the Bureau of Labor Statistics and say, we laid off this many people or we hired this many people. Last in January, it was 27%. So we're getting employment data. We got 167,000 job negative revision in the last payroll employment report. And it's not that they're manipulating.
And once again, this goes back to why people don't trust the government data.
The data, the conspiracy theorists go bananas with this stuff. It's really that they don't have a good collection mechanism. So the revisions are significant, and most of them have been negative, Mel. So I think that some of the Lululemon, some of the consumer hits that have happened. If you looked at Lululemon a month ago, it's up and to the right. Yep. It's parabolic. It's like everything else. And if you look at the Russell 2000 a week ago last Wednesday, it's down for the year.
Wait, what did he say? Up and to the right. Lululemon. Wait. What? Lululemon stock is in a horrible place. What is he saying?
Last payroll employment report. And it's not that they're manipulating the data. The conspiracy theorists go bananas with this stuff. It's really that they don't have a good collection mechanism. So the revisions are significant, and most of them have been negative, Mel. So I think that some of the Lululemon, some of the consumer hits that have happened. If you looked at Lululemon a month ago, it's up and to the right.
If you looked at it a month ago, okay, yeah, that's fair. Not anymore.
It's parabolic. It's like everything else. And if you look at the Russell 2000 a week ago last Wednesday, it's down for the year. So I think it's just a little bit of perspective on the economy slowing and what it might mean for rates and the consumer.
So what benefits in that environment where the economy is weakening?
Yeah, the issue is, with some of this, you get some good data, you get some bad data. Oh, they're talking about, previous video, they were talking about, GDP might be above expectations, right? He's talking about weakening data. He's talking about government numbers are then getting revised worse, right? So where's the Fed play in all this? Well, the problem with the Federal Reserve is they don't take actions really until it's too late. And it's so far in front of their face that it's indisputable at that point in time. They don't really forecast anything accurately, and they don't really make moves for the future. They wait till it hits them in the face. Everybody and their grandma knew inflation was out of control by the time the Fed actually started raising rates. There was no secret. Ask any regular person out there, they'd say inflation's out of control. And the Fed didn't start raising rates until everybody knew it was out of control, right? And so, in trying to predict unemployment and those sorts of things, the Fed might start making moves when everybody's like, ooh, it's already getting bad. And whenever that is, right? And so, I don't know, that's just a little food for thought in regards to that. The Fed doesn't make moves until everybody already knows it.
And we do have rate cuts.
Well, our focus now is those rate cuts are what you need. You need to kill the zombie, right? And the zombie is an economy that you're waiting for it because of the inversion of the yield curve and the higher interest rates to slow down enough to go into recession. Until something happens with the Fed and lower rates, it's going to be very hard to disprove that you can eventually go into a recession because you normally have. Our view is that all of the earnings growth from 2023 was the Mag 7. According to our earnings wizard, LSEG, it literally was a negative number for earnings growth last year, ex the Mag 7. It's same for this quarter. It'd be a negative number. As we go into the end of the year and into next year, it's much more even. So that's where we're calling for the broadening of the market. It's coming from a broadening of the earnings growth participation. It's not just the Mag 7. So if you get lower inflation and lower interest rates and start to get scared about the unemployment rate going up, that sets the stage for that real early cycle recovery we can get in those areas that benefit.
So I don't agree with this whole notion about buy stocks that will benefit from lower rates on weakness. And the reason I don't necessarily buy that is whenever the Fed does start lowering rates, it's usually because you're going into recession. They're usually not just going to lower rates to lower rates. It's usually because recession's either there or it's coming very soon. And so some of those stocks can still get hit very heavily if you go into a recession.
That sets the stage for that real early cycle recovery we can get in those areas that benefit from lower rates.
So what if you get a little lower employment, but really not a lot of relief on the cuts? Let's say you get one. Does that change your outlook?
It would. Where I'll be wrong is if rates stay here or actually go up. I find it very hard to believe that that's going to happen, Kara. Like if you think about when rates were going up, it was the end of the higher inflation where they did 4 rate hikes of 75 basis points at a clip to slow it down. The trajectory of the core PCE, which we get tomorrow, is exactly the opposite right now. So if it goes down a little bit more and it stays on this trajectory, you get a continued move up in the unemployment rate. You get a continued move down in the inflation rate. Karen, I can't imagine they're going to go 25 basis points after going from 0 to 550. They're going to go, oh, 25 is enough. We're good.
Zero. So zero, that's the
yeah. So call it 2 to 5. We're that 5 1/4 is the upper end. Maybe it comes to 4. That's enough to really kickstart. That happens with weaker employment. That happens with weaker spending. And I'm not saying they have to go back to 0, but they have to be more aggressive to reinvert in whatever they do to get the curve back to normal.
So we've gone from higher for longer, right? That was the mantra. And of course, the exact opposite happened. Rates dropped from 5 to 3.8. Then at 3.8, consensus was there'll be 6 cuts, 7 cuts. That's all off the table. Now it's 1, maybe none. What if there is, just as you're implying, nothing? They just stay pat. And
Good
don't
question.
stand pat.
Good question.
By the way,
it was a political term back in 1896, referring to patents, but it's still a poker term. We should keep moving.
Remember, they were only going to do 3 hikes.
Right, 3 hikes. So 3 hikes
in the
and then 3
beginning of
cuts. But let's say
22.
they actually just somehow keep juggling the ball and do nothing. Do you think that is Goldilocks or that's a problem?
I think that creates a bigger recession. Problem. Yep. I think the Fed needs to get, I'm kind of on Steve's camp, the Fed needs to get aggressive here. Remember, when inflation was moving up and spiking like it's moving down now, they were telling us they were only going to do 3 hikes. We're good after 3 hikes. That's the peak rate. Not so much. So if you get weaker employment, the whole picture here for the economy is we're at full employment. Manufacturing's been in a recession for the better part of 2 years. Non-res construction's turning over, so...
Really quick, because I know we don't have a lot of time left, but I heard you say zombie refer to our economy.
That was a great question. I'm glad he got that in, didn't get distracted there, because that is like a good question. Like, what happens if the Fed doesn't lower rates this year, right? And I believe, I'm 100% on the board with him in terms of the thought process of, okay, they don't lower this year, probably creates a bigger recession down the road, right? Whenever that ends up happening, right? They'll just create more problems out there in general, right? So I'm definitely of the belief, on
zombie terms. And yet we also have a dynamic also out there for markets where financial conditions are out of control.
So without Fed moving.
None of this seems to make sense, and yet you think the Fed hasn't moved fast enough, and I think they lit the market on fire last week.
Oh, they absolutely lit the market on fire by staying with 3. Remember, they revised the growth and inflation up, but stayed with 3 cuts. He also said we're at the peak of the cycle in terms of rates. That was not gray. So I'm not saying that we go into a service-based recession and the market collapses. There is no history I can find with this kind of momentum that calls for market collapse. At this point, when you're this overbought and this extreme to the upside, you just want to wait for a better opportunity. In our view, that comes with this worsening employment data that cuts rates. You worry about the economy. That's when I want to go in, not levered long at, after the kind of rates that we've been, or the kind of moving stocks we've been talking about.
Yeah, a little worried about, once again, commodities, right? And I'll show you guys kind of what we're looking at here. And this is what is giving me a little, concern out there. If we look at GSG, the commodity basket, there it is. So far this year, up over 10% now at this point in time. Holy smokes, is that accurate? Double digits? Holy smokes. So that's the issue right there. If this continues to roll into summer and you get oil price, next thing you know, we're at 83 already on oil price. Let's say this summer we hit 100 plus, then you got inflation problems. You still got inflation problems in the economy. And what does the Fed do if commodities are going through a major bull run? With oil going through a major bull run, like, what does the Fed do? Like it's going to be hard to cut. It's going to be extremely hard to cut if that's the scenario that plays out, which then makes them potentially even have to consider raising rates again to calm the commodities market down and make more recession fear. So that's a whole dramatic situation. Okay, so we'll see how it all shakes out, but yeah, it's going to be quite a show. Okay, appreciate you guys joining me as always. Thanks so much for being here. If you're looking to learn on the deepest level from me, everything I got up here, then apply to join a private group. We can see if we can get you in there next week. That will be the pinned comment down there. You can click on that and go ahead and fill out an application. And once again, we'll see if we can get you in there next week. Access to all my premium course curriculums, our Discord chat, be able to see the moves I make my $2 million plus Fidelity account, all those sorts of things. Much love and have a great day.